Hey everyone, in the last video we talked about what GAAP was. In this one I'm going to talk about the principles of GAAP. And there's four main principles of GAAP that we follow throughout all of accounting. And if it doesn't follow one of these four principles, then it's really not following accounting. So the first one we're going to talk about is what's called the measurement principle. The measurement principle states that accounting information is based on actual value. Not what we think it's worth, not what it's appraised for, it's what it actually cost us. So if you purchase a piece of land for $10,000, but it's actually valued at $15,000 at the time of purchase, and then later on you have it still 5 years later and it's appreciated up to $25,000, it's still going to be on your books at $10,000, the original amount that you purchased it at. And that's what the measurement principle really talks about. The second one is called the revenue recognition principle, or RevRec. And this states that revenue must be recognized, one, when the goods and services are provided to the customer. So I have rendered the product or the service, and at the moment expected to be received from the customer. So the revenue recognition principle is a really important one because it's telling you when you have to recognize revenue. It says it in the name. Revenue is predicated on, is the product or service rendered, not did we get it in cash. We'll talk about that a little later on in another video. The next one, the third one, is the matching principle. And the matching principle is pretty much the same as the revenue recognition principle, except it's dealing with expense. This is stating that the company must record its expenses in the same period used to generate the revenue. So, just like in the revenue recognition principle, it tells us when we have to recognize revenue, the matching principle tells us when we have to recognize expense. And it just has to be in the same period at which we used it. And then finally, the fourth principle is the full disclosure principle. And this states that a company must report the details behind the financial statements that would impact users' decisions. And these disclosures are often found in the footnotes of the statement. So, throughout this course, we're going to talk a lot about different methods, different ways of doing things, different procedures. And in that, when you're choosing what method to use, you have to state in your financial statements that this is the method I use and this is how we get the numbers. Or this is the percentage that I use, or this is the percentage that I estimate. So you're given everything of value to the end user to see, okay, what are they using in order to get these numbers? Again, full disclosure, we want to tell everything to everyone. So that's it.